What's up, guys? We have a fairly laid back video today. This is Cash Flow Cart, and today we are getting into a recent move I've made in my portfolio. I think I need to disclose anything for sake of transparency. I should disclose, big moves like this, and this was definitely a big move for me. We went ahead and took off 13 shares of Apple. I had 63 shares, and we took that down to 50. So you can see my fill on that sell order was 214.94. We'll call it 215. I did realize some profit that I will have to pay, long-term capital gains tax on, but I'm not too worried about that, guys. Today, we are going to get into my reasoning for selling Apple, selling a portion of it, what I did with those funds, and we're going to talk about kind of, where my head's at. I want to keep this as high level as I can. The proceeds from that sell did go into my Hershey position, guys. I will be releasing a video on July 1st covering my decision to start a position in Hershey. But today we're talking more from the level of portfolio management and such. So without further ado, guys, let's get into it. We're going to review some stuff. Starting out, we'll just take a glance at the portfolio and what really happened. I do want to announce the average monthly income with this new move did cross that $200 mark. We are at $204.06. That will be my average monthly investment income over the next 12 months. If we look at it quarter by quarter, in July, I will make $300. In August, I will make $110. And then in September, from dividends, I will make $202. So I'm pretty happy with achieving this goal, breaking the 200 mark, breaking the $2,400 annual mark. But, now it's on to the next goal, which is going to be 250. I hope you guys will still be with me as I continue to chase these milestones. Let's look at what happened in terms of allocation within the portfolio. So since Apple has been at all-time highs, it was my number one position. After taking off 13 shares, it took it down to my number three. The market value of Apple is $10,714.50. And I have spoke on not wanting to sell that position. However, this was kind of a rare occurrence for me to go ahead and realize gains, to that degree. I'm probably going to keep Apple at 50 shares for the foreseeable future unless we get some kind of, tech industry pullback. If you've been with me, my estimated income from Apple was $60. That sell took it down to 50, so I lost $10 of dividend income from this Apple position. But I was able to build the Hershey position. One share I purchased using my debit card. One share I purchased using dividend checks. And then 15 shares I purchased using the proceeds from Apple. And the market value of Hershey is now $3,106.41, guys. And that pays me $93.16 estimated over the next 12 months. So, just in one day, just by making a few strategic moves, I've essentially increased my income by $83 annually. Obviously lost 10 from Apple, gained 93 from Hershey. We will do like another full portfolio review probably in the video after this. But I did want to show kind of how this strategic move, affected my annual income. Now, let's take a step back and let's look more high level. We've spoke on this before, and here's kind of my take on diversification, guys. Each year in the market, there's going to be sectors that outperform, and there's going to be sectors that, underperform or lag the market. depending on what the overall market is doing that year. And what that does for me is it allows me to get diversification in my portfolio, over time. Does that make sense? So, if one sector is performing relatively bad compared to the market, maybe that sector is where I'm going to be able to find kind of my opportunities. Okay. That's where I'm going to be able to bargain shop per se. And I wanted to bring this up because obviously, if you guys are keeping up with the market, which I am assuming you are, we have seen the information technology sector, which would be Apple, Nvidia, Microsoft, Google, plays like that. We saw it have, a great year in 2023, and in 2024 year to date, it's still one of the better performing sectors. Okay? And with that being said, Apple being the largest stock by market cap in the S&P 500, obviously Apple has had, some pretty stellar performance, I'll say. We did see Apple hit that all-time high of 220. So if you guys can see what I'm getting at here, basically by making this move from Apple into Hershey, I took advantage of the outperformance in the technology space, and I moved those funds into a sector that hasn't been performing as well. Okay? Being consumer, I don't know if we want to call Hershey consumer staples or consumer discretionary. I think it's technically consumer discretionary, but there's definitely some people out there who view chocolate as a staple. So either way, I took advantage of kind of this consumer staples and consumer discretionary sector underperforming while realizing gains in, the overperforming tech sector. Does that make sense? So with a strategic move like this, I can hopefully get some capital appreciation in Hershey, as well as some dividend growth and a higher starting yield. I locked in roughly a 3% yield on Hershey. Like I said, I covered the new position in last week's video, but today we're talking more strategic stuff. And we've actually been talking about, kind of taking advantage of this consumer discretionary underperformance for kind of a while now, I'd say. Because in 2022, consumer discretionary was one of the worst performing sectors. I'd say everything did pretty good in 2023. But year to date, we've seen it struggle to keep up with the market. Does that make sense? And I think what kind of started it off was, this guy. This was a big talk of the market in 2023. And this article came out on October 6th of 2023. Ozempic threat is spurring a slump in snack and beer stocks. We talked about Ozempic hitting Walmart. We talked about it hitting Coke, Pepsi. And I'd say the main topic of conversation on the channel was, okay, how can I as a dividend investor take advantage of some of these dips in these names that are being affected by Ozempic? And, I'm proud to say I feel I've finally done that by starting, not a small position in Hershey. It's my number 7 holding now. I did go ahead and take it, higher than T. Rowe Price. I still do want to build out T. Rowe Price. It's just been, I don't know. It just hasn't been the number one focus. It's not going anywhere. But so basically what I'm getting at here is I was able to take advantage of an underperforming sector, find a stock with a higher dividend yield, and still stellar free cash flow growth, and I realized some gains on the Apple position. Okay, so that was my strategic move. One more thing I want to cover in case this isn't resonating with you as well. We will look at the individual stock valuations. So we'll start with Apple, and then we'll compare it to Hershey. And the idea here is that we're going to demonstrate, okay, Apple, clear overvaluation from a dividend investing standpoint, and Hershey, clear undervaluation. Okay, so if you've been with the channel, You guys know, I think the simplest way, like the step one to identify undervaluation from a dividend investing standpoint, is going to be our price to free cash flow on a forward basis, guys. That's going to take the stock's relative price divided by its operating cash flow per share estimates on a forward basis. Okay, so we're on Apple. We can see Apple's price to free cash flow multiple right now today is 26.57. Okay, we see that right here. And their 5-year average, which again is what I like to use, I'd prefer to use Apple's 5-year average rather than the sector median, because I do understand that, you know, a company like Apple is probably going to trade at kind of a multiples premium. So Apple's 5-year average is 21.79 compared to its current 26.57. We can see clearly that Apple right now is trading rich. Okay, it's trading at a premium of 21.92% compared to what it's been trading at on average over the past 5 years. Okay, do we see that 21% overvaluation? Again, guys, we're just looking at one metric right here. I just want to drive that home. And then we look at the same thing with Hershey. What do we see? Price to free cash flow on a forward basis on Hershey is 13.49%. You know, we look at that metric over the trailing 5-year basis, and it's 24.5. Okay, so with this in mind, this this data suggests that Hershey could potentially be 45% undervalued, you know, just from the standpoint of price to free cash flow on a forward basis. Okay, I hope that resonates well with you guys. I've tried to walk through a few different ways of kind of identifying value in the stock market. And the last thing we're going to do before we wrap up this video, guys, is we're going to look at the charts. And, you know, I do go more into depth in my other videos, but we'll start with Apple. I don't know necessarily how much value a lot of you guys put into, you know, technical analysis. I know that's kind of a taboo thing because some of you might be like, oh, trading technicals is gambling. And I don't want to say I'm just trading technicals, but I do like to use, you know, technical analysis to help me with entries and exits. And, you know, for the sake of that, we're going to go over it. So, you know, you guys can see Apple's been kind of a long-standing position in my portfolio, which has led to a pretty attractive cost basis of $145.50. This actually was $117. It got adjusted, obviously, for FIFO. But now my cost basis on Apple is $145.50, guys. I took off, you know, 13 shares after I saw Apple hit this kind of all-time high of 220. You know, I took off 13 shares near the all-time high. And I do want to speak on kind of, we do see price kind of overextended from this 50-week SMA. You guys know that's a moving average I like, as well as this 200-week SMA. Okay, I don't put all the value in the world on technical analysis, but again, I'm just speaking from that standpoint. You can see these two red lines here. I've drawn kind of a ascending wedge pattern in Apple that's kind of been forming over the past 3 years. And I'd say from a technical standpoint, it does seem that Apple is due for a correction, you know, back down closer to this 200-week SMA. Probably going to bottom between, you know, 156 is the 200-week. I'd say it's probably going to make a correction and bottom between 156 and 180. Again, this is just from a technical perspective. A lot can happen, and there's a lot of other factors at play, but I'm just giving you guys the rundown on, you know, what I see if I was solely a technical trader. So again, realize these 13 shares, and we'll head over to the Hershey chart. I mean, you guys know I've been watching this one forever since since we really discussed Ozempic, and I've got older videos covering, individually Hershey, but it's good to finally add it. So from a technical standpoint on Hershey, I have mentioned sometimes when we get these dips of price below the 200 week, it has kind of signaled a buying opportunity. Again, I'm not saying that has to continue kind of in perpetuity, but we do see price right now consolidating right beneath, this 200 week. So I went ahead and pulled the trigger. We've seen Hershey consolidating for about 8 months now, and this could end up being a pretty good entry if Hershey does start to reverse some. And on the flip side of that, if Hershey doesn't reverse and continues consolidating or continues falling, all that's really going to do for me is allow me to say, okay, now I've got more opportunity. Now maybe I have a better dividend yield. How much more, or a better starting dividend yield, how much more do I want to build out this position? Okay, we talked about it right now. It's the number 7. I'm pretty comfortable with my position sizing in this one. I built it out relatively fast, being literally in a span of 1.5 trading days. I built this position out to $3,800, which is pretty rare for me. But, we're going to have to wait and see. We're going to have to take what the market gives us. And I wouldn't be opposed to, if this one does reverse and I go ahead and just leave it in the portfolio and enjoy the position. Otherwise, I probably want to take it up to 20 plus shares at some point in the near future. But again, we will have to wait and see. I'm not going to force anything. And again, guys, thank you for joining me. I wanted to go over kind of where my head was at today with the strategy behind this, I would say, bigger portfolio move. Anytime you add a position, it's a pretty big deal in your portfolio. I mean, I don't want to be one of those channels with 40 plus positions and I got like a couple $100 in all of them. At that point, I'm not really offering any kind of conviction of my own, not to hate on those guys, but I think if you're going to do kind of this individual dividend growth investing journey, I think you kind of need to have some conviction in your positions. You should take this, pretty seriously. You should take calculated business risk. Guys, again, thank you so much for joining me. I post videos every Monday night at 6 p.m. and I would love to have you guys as part of the community. I hope you like this more kind of informal, thinking out loud video for this move. But again, feel free to hit that subscribe button, and I'll catch you in the next one. Let's build wealth.